The Cannabis Conversation. A European perspective on the emerging legal cannabis industry.
Welcome to the Cannabis Conversation with Anuj Desai, where we explore the new legal cannabis industry by speaking to the professionals that are helping to shape it. On today's show, I have Matt Nordgren. Matt is managing partner of Arcadian Fund, which is a private equity fund that is focused on the cannabis industry. Matt is in the US.
Yes, US.
Where exactly are you?
California, Los Angeles.
Very nice, very nice. So Matt's joining us today from California. How are you doing?
Everything's going well over here, considering the circumstances. It feels like we're starting to get back to a little bit of a new reality. I don't know what that reality is. I don't know if any of us do, but it seems like people are moving in that direction. That's a good thing.
Yeah, 100%. I think things are starting to move positively in London too, and I'm sure around the world. But we're here today to talk about, well, I was hoping you could give us a bit of a lesson in raising investment, a bit of a 101 lesson. But before we get onto that, it'd be great to hear a bit about you, a bit about your background and how you got into the cannabis industry.
Well, happy to do it. I think like many people, the industry has two major draws, and that is the generational wealth creating event that is happening and is going to continue to happen. But I think outside that, the good for the world that we're doing, and this botanical wellness, this medicine during a pandemic has been proven to be essential, and it's only picked up in terms of the quality of life that it's delivering to people. So those two factors pulled me in. And then I think what ends up happening to you is you spend more years in this industry, you start to realize that the entrepreneurs are amazing, but the customers, the clients, the consumers are even more amazing. And the stories you keep hearing on a daily basis is what really encourages you to, keep trying to do your work here. During times like these, if you're a doctor or a nurse or a politician or a lobbyist, there's certainly other things you could be doing. But as a business person, just very thankful to be in this industry and feel like the work we're doing is for the overall good.
Great. And what were you doing before you moved into this space?
Have always been in finance. My early career was a football player, United States NFL football player. And after that, I did a little bit of TV, did work with the family business. I mean, it was kind of all during my early 20s, but immediately went into business. Have been in finance my whole career, running a family office out of Dallas, Texas. And then I moved to California, started working in a family office environment there, running a variety of strategies. Ultimately, always knew there would be something to come along that took time and attention and built something of my own, and really was looking for that. Probably in my early 30s, felt like was ready for the moment, and cannabis and hemp ended up being the most perfect place to sort of direct that energy. Managing family offices, I've managed private public strategies. So ultimately, when you sort of spend 10, 15 years developing a skill, you can kind of redirect that. And I think at some point in a person's life, all the stars align. And I think that's what happened in this space.
Fantastic. That's really good. And maybe tell us a bit about Arcadian quickly before we get into the sort of nuts and bolts of investing.
Okay, yeah. We decided early on that it would be kind of a smart strategy to look at what happens in emerging industries and who kind of builds a platform to take advantage of an opportunity versus being a transaction-based finance person or, sort of more one-off deal based and building a strategy. And really just felt that in an emerging industry, you really want to be hedged. You want to be diversified. You really need to, try to figure out how to reduce risk because when you're in an emerging industry, by definition, you don't have institutional support, which means more risk, which means more opportunity. So I think we wanted to build a portfolio approach, and what we did was launch Arcadian. And Arcadian, since the early days of cannabis, which is nice being in California because it really seems in a lot of ways like it had been the epicenter over the years. Certainly now that's changing, but California is still responsible for 90% of the cannabis industry. And I think, a fourth of the entire world's revenue for the industry. So
Wow.
you see, it's sort of a melting pot in a lot of ways, similar to what San Francisco was for the tech industry. That ended up being LA, and I think still is. And so as you sat here, you sort of say, okay, well, if you believe in the industry long term, what would you do if you, again, went back to San Francisco in the mid 90s? What would be your ideal firm? What would you create? Well, you'd say I'd create Google, Facebook, Apple, Amazon. But the reality is there were thousands, hundreds of people that tried to do that exact same thing at a specific point in time. But for us, we knew there was going to be a Google, Facebook, Apple, Amazon of cannabis. But in order to ensure that we were involved in those businesses, we'd rather build Andreessen Horowitz, KKR, Sequoia. So we built Arcadian to be a hedged, diversified asset manager, taking venture capital risk from an equity standpoint in an emerging industry. Today, we have 35 companies in the firm. Very happy to report that as of today, we have no companies in major distress. That's exciting. Not many portfolio managers can say that. I think a little bit of luck, but luck, chance favors a prepared mind. So you have this beautiful portfolio of companies. You're well hedged. We're equity. And during this time, we really feel like that had been the best approach. Build a portfolio, build a collaborative effort, build a team with a lot of perspectives, a lot of diverse knowledge and experience. And that's really played out very well for Arcadian as an asset manager of equity, growth equity investments in the cannabis and hemp space.
Yeah, fantastic. Wow, there's loads to talk about there. And obviously, you're perfectly placed there to talk about how businesses raise investment. You raised a quick point there that I actually wanted to clarify. You mentioned venture capital versus equity. What's the difference and what in terms of approach, private equity and venture capital?
Well, if you look at sort of a J curve, if you will, of a business when it first starts and it sort of spends a year or two raising capital, getting things going, all of a sudden it starts to go well. Next thing you know, it's starting to generate cash. Before you know it, it's cash flow positive, and then upward and onwards you go. During that J curve, you sort of start to see different types of investors. You have investors that like to be your first check-in. Call it friends and family, call it angel, call it seed. There's a couple of stages of investments that really is in that downward portion of the J curve. When you're starting your business, you're growing your business, you're not expected to be a cash flow positive business for a period of time. And during that time, you need capital to get to a point where you show you have a real business. And that largely is a community of investors that the cannabis industry had from the beginning. And very quickly, it moved past that. And the natural transition for an industry, an emerging space, is to go through angel, family and friends, angel investing to seed investing to sort of an equity round before a real priced equity external round, but also external of just friends and family. Maybe you have a few new investors. So before you get to an A round, which people talk about as usually the first outside round of equity, you have to have a few of those things in place. An A round investor, which is more properly qualified as a venture capital investor because you're taking venture risk. And in the US, you can define that very specifically. In the 1970s, US government worked out a few things to give advantages to people who built structures that looked like venture capital. And in order to do that, they receive venture capital exemptions from a tax reporting, insurance, auditing standpoint that are beneficial because you're managing less money when you're taking early risks. So you have to have some of those exemptions if you're actually going to function as a manager, because remember, managers operate on carried interest and management fees. And so your carried interest usually is not till back end incentive. And so you have a very small percent of capital you manage to run a business. And that's normally 1% to 2% on an annualized basis. So you have to have these exemptions in order to even be able to function as a business if you're managing 10, 20, $30 million. Can't hardly have 2 employees for that at 2%. So venture capital was given these exemptions in the 70s. At the same time, capital gains and some other things on the tax side. And so after that, you had Microsoft. You had all these computer and tech companies. You had into the 80s and 90s and 2000s, Facebook, Apple, all Google, Amazon, all came out of this venture capital mindset, which was there has to be a way to take companies from I've put my own money or my friends and family money in it and bank money, and then ultimately sophisticated private equity has to put out really big dollars to make it worthwhile. So venture capital fit this really nice void, which was sort of in between friends and family and big, private equity. That's how I would define it, Nuj. But in cannabis, what you had early on, and this is typical of every emerging industry, you don't have the entire value chain of investors. If you're going to go invest in, some type of frontier real estate business, frontier technology and real estate or something, you're going to have investors across the entire supply chain. You have investors at every little stage of your business. In cannabis or in an industry like this, we have all these regulatory concerns. You don't have all of those types of investors. You basically had people who are willing to go early, people who are venturing and willing to be in the middle, and then you had people at the end that were willing to be just before you went public or try to have an M&A transaction of some kind. So it felt bankerish or not even private. Private equity wasn't even in. Now you can feel like there's a little bit of private equity because you have companies doing true late stage growth rounds with big dollars with less risk in a later stage after a company's raised 3, 4, 5 rounds. That feels private equity like to me. But in the early days, you basically had people who invested in the beginning of a company, everybody in between, and then people at the very end. And so that wasn't good because what you had was basically as companies built themselves for a couple of years, you either had groups like ours at Arcadian and other great venture and private equity firms, but really called growth equity firms because we were focused on growth equity, or you went to a banker because there wasn't private equity. We call ourselves private equity because we're private equity guys, but the reality is private equity is to look at doing larger positions in companies, more mature companies, traditionally M&A or controlling stakes or very large stakes in very mature businesses. In cannabis, you didn't have that. So what ended up happening is because you didn't have institutional or private equity like capital or bank capital or debt or credit, these companies got big enough, they either had to go take growth equity money from the 10, 15 groups like us that had capital committed to them, or they would go to a banker or broker or public market trader, largely in Canada. And you'd skip that entire process. Businesses naturally want to grow through this process. You shouldn't have to be more than you are more quickly. You should be able to grow with the pace at which your business allows you or the market you're addressing allows you by taking around, putting a valuation on your business, accomplishing a certain amount of goals for a finite period of time, and then having investors that are willing to give you more money to get to the next hurdle. And that's what growth equity, that's what venture capitalists do. And so companies in cannabis skipped that stage. They wanted to go public. They let the markets dictate the valuation of the business. And in most cases, you had companies trading at unrealistic valuations, manufacturing, agriculture, and brick and mortar retail businesses trading at sometimes 50 to 100 times revenue numbers, which in a normal market, those assets trade at a 1 to 5 multiple. So there's a significant difference. And if you're a transaction-based finance person, which I'm not, my investors would say we need to be open to that, and we certainly are. We have transactions, but we're here to be equity with a company. And that means we ride out for death till death do us part, for richer, for poorer, for better, for worse. When we invest in an A round or B round equity in a company, we're there with the founders and with the management team until we all have an exit event. So these transaction-based finance folks saw that they had no great option other than venture capital than to be involved with the transaction finance person. So it allowed valuations to get out of hand, quite frankly. And when you don't have a long-term vested interest in the business, you'll almost say whatever to get the company out. And that happened for a couple of years. And it's okay. The industry grew at 36% compound annual growth on an annualized basis. So you'd think there's enough growth there from a cash flow standpoint to substantiate a little bit higher than normal metrics on your valuations. But they were so overly valued that even at 36%, you couldn't make it work. So You had that value reset during 2019 and 20. Thankfully, before and during COVID, it was already being done. And so I think what you have now as an industry is less focused on just transaction and people really focused on the growth of the industry from an equity standpoint, hovering somewhere between venture capital and private equity to grow companies as they should before institutionalization where transactions take place.
Yeah. Yeah, huge amounts there. And actually, we could do a couple of shows on just the stuff that you talked about. But that's a very useful way to clarify things. So thank you for that. So if we're going to go back to, I get contacted by a lot of entrepreneurs looking to raise money, as I'm sure you do. And I thought it would be a really useful show to just sort of give some tips from your perspective on the things that you see and how people can maybe improve their game. I mean, I took a really kind of cursory look at this in terms of, I was going to talk about the idea and the team, but if there are any other big points that you think we should cover, please do let me know. So maybe we start with the idea. I think people obviously get very carried away with, I've got this amazing idea, and they think, whoa, now I can relax. But obviously it's the execution. What are your views around the idea and, how you present it when you're trying to raise investment?
Well, the first thing you really have to do is understand the appetite of who you're talking to. I can't tell you how often this happens where the person, the entrepreneur, the business, whoever's presenting the idea, doesn't do a proper job of understanding exactly what the appetite of the investor is, and then where is the margin of error on either side as to typically how far they would go outside their comfort zone and do a deal. You can go on an investor's website, you can see their portfolio, you can research the individual you're talking to at the company, see what type of, it'd be like a lawyer going into a trial. If the lawyer didn't have a great idea as to what kind of judge it was, what kind of jury there was, they would basically go in without having an idea as to how to phrase that idea, how to position that idea. And I think every bit of knowledge you can have about who you're going to be sitting in front of, the better. For example, in the case of a lawyer, if you're sitting in front of a conservative or liberal judge, that may alter the way you're going to say something. If you're going to present an idea to it from a business standpoint to an investor, understand what that investor's basis is. Where do they like to come from? In my case, you could go on our website and see Arcadian is a growth round investor. You could look at our 35 companies and see what type of companies they are. And ultimately, probably even read our mandates. And so you could look at that and say, okay, I'm going to go in and talk to these guys. Looks to me like they like to enter in an A round. Clearly says they don't do first round investing, but they're definitely, they don't appear like bankers to me. They're not public markets guys. They're not trying to, do that type of work. So the idea that you would present to me would be based on that window of where I like to invest. So if your idea was at the seed stage, was an angel stage, was a very early investment, then you would understand that if you were sitting in front of me or my team, that we like to enter a little bit later. So you may say, here's my idea. And by the way, my idea has a little bit more work to do. I realize that your investor appetite is potentially as a little bit more scale, is a little bit later in a business cycle. So I'm thankful to have this time with your group today because I'm going to tell you some things that I'm going to accomplish. And whether you come in now or my next round, I want you to be aware of us because this idea is going to be taking form. And I'd love for you to be part of the journey, okay, if you were early. And so that idea would now be presented to me with the lens with which we view business opportunities. All too often, someone who has an early idea presents a business plan to a growth investor the same way as every investor they talk to, but that you'll get lost. We won't be able to track you. That's not our expertise. So I would say that understanding the investor you're talking to more will help you present your idea in a format that the investor you're talking to will be able to actually identify and not tone you out. Said another way, if you're on the other side of the spectrum, if you're a big, scaling meaty company and you're talking to an investor on the early side, well, you want to understand that too. Hey, I realize we may be raising 25 million. Your appetite's typically, $250,000 checks, something like that. Now you would understand, hey, I'm not asking you to be my lead investor. We're raising a $20 million round. I think we have 10 to 15 million in a lead or soft circled. You seem to be somebody who likes being involved at a certain size. How about I come back to you with a follow-on investment once I have my lead secured, where you might be more confident in this round. And so understanding that someone can't write 10 million if you need a lead 10 to get the other 10. That's really important. So it doesn't matter what side you're on in terms of where the investor sits with their comfort level and mandates based on your business opportunity. You just have to understand where they are and understand where your idea is and properly address it with respect to the person you're talking to, not generally as you present any idea.
That's really useful. Basically, do your homework on who you're speaking to and then tailor your approach accordingly. I think that's really useful because I think people are just like, I need money, get me in front of as many people as possible. And, I haven't gone through this myself, but certainly speaking to people that have, it's a huge amounts of energy go into these things. So you kind of want to be selective, right? Where you're most likely to land your message.
Right. You really want to know that you're being effective and efficient at the same time. And it's benefiting the entrepreneur and it benefits the investors. Because I can tell you one thing, all of us have to raise capital. I have to raise capital. I have to raise capital for our platform, our funds, all of our funds. I'm always raising. The best sales job you can ever do is when someone misses your deal and you do it in such a way where they stay in touch with you and they're able to see your progress. And if your idea is in a stage that's too early for an investor, the best thing that can happen is they say no, and they like you, and they say, send me your updates. I want to stay, on top of progress. And you hit your goals and the idea becomes a reality. You have to invest. If I stay in touch with someone for 6 months or 12 months that was too early and I like them and they're investing other people's capital and they're performing, the confidence that I would have come time for their next round, which may be a fit for me, is significantly higher than if I didn't have the conversation in the round that was too early and passed and was able to know the business, know who the person was. And 6, 9, 12 months later, I was able to see what they say was going to happen actually happens. That's the best sales job you could ever have. That's the best sales job you could have. So don't feel like you have to force an investor to move outside of his comfort zone and invest. If you don't fit it perfectly, that's okay. Use the time wisely.
Yeah, timing is key. So there may be opportunities to still get involved a bit later down the track. So in terms of maybe the team actually is what we talk about next. This is something that all investors labour quite a lot to me, how important the team is. What are your views around that and how you present that in relation to speaking to potential investors?
Well, it depends on the industry you're in. If you're in the cannabis and hemp space, for me, it's really important to know that a team has the ability to overcome obstacles. Because in an emerging industry, you don't know what they're going to be. You have no clue. And you have to expect a continued onslaught of problems. By definition, you're in an emerging industry because institutional players don't want to take the risk because the risk is too great. Institutional capital, that J curve we talked about, if you're an investor, as you move up the very highest end of the J curve, the largest asset allocators, pensions, endowments, you name it, they aren't looking to generate 20% returns with their capital. They have so much capital, billions and billions and billions and billions of dollars. All they have to do is generate 4%, 5%, 6%. And that's at the highest level of J curve. So each step you come down to, cash flow neutral, cash flow negative, early stage company, the risk is greater. And for that risk, you need a greater return. And so if you're going to invest in a seed family stage of a company, you have to hope you're going to hit north of 20% returns. The reality is 40, 50%, and it's going to take a lot of years. So that's where, I think that the team, I'm just, looking at team, every part along that J curve, the team has to get stronger. As you move forward, you have to add pieces that give confidence that you're going to have an opportunity from a management team perspective to present less risk to the next level of investor, because they don't need you to be presenting some crazy return case. They need you not to mess it up the bigger you get. So teams really important in an emerging space more than probably any other space, because you don't know what's going to happen. That uncertainty that the institutionals aren't willing to take a risk on, venture capital, growth equity is. And so what you look at, let's just take cannabis and hemp. If you go back to 2018, could you have predicted that there would be a public market correction in value? Probably. I mean, most of us did, but it was still coming. And you had to have entrepreneurs and a team that were willing and ready to deal with all that was going to happen from that particular fallout on the public side. Then you had, I don't know, vape crisis. Vape crisis happened. Now you had a vape issue. Then you have COVID. You have these riots that are targeting cannabis stores. You really don't know what is going to happen in terms of a problem or a fire. We look for teams that are willing and able to solve anything that comes. And it's hard to actually quantify, who has the skill in a team to do that. A lot of it is because we're not a investor who goes in the very first check, because we're a second or third or fourth type of check of investment. We get to see a little bit of what the team has done. We get to see a little bit of maybe 6, 12, 18 months of performance. We typically aren't the first outside round of capital, so we like to see an external round of capital placed and see how the team responds to it. Usually when they have that first round of capital outside capital, they're going to add a few people. How does the current team do with adding new team members, and how do they manage that? So in the first, round of investment or two, it's actually pretty hard. You have to go on a person or a team's previous history, and a person's previous history can be very helpful, but ultimately, if in a new industry with a new team, can potentially not work out. And that's why we like to see a little bit of traction before we enter, so that the team has had some time to develop and form a little bit, which gives us a better idea is this a team that can manage through what's to come. If you're going to invest in a team in the early stage and present a team without performance for that business or that team, then you really have to do a good job of fleshing out a story that relays to investors this team's qualified from the past to handle the task at hand. And you probably want to go out and, because if your business is early, you may not have the capital to hire the greatest executives in the world. You'll have a couple that are founders probably, but you'll need some advisors. You probably have to go out and add 3 to 5 people that are willing to take a call and say they're here to support the effort, that have a great amount of expertise in your particular area of business. That will help your story. The idea is one thing. The team to execute that is probably more important than the idea at the very early stage, because the idea won't be the same idea at the very end of the day. If you went back and met with, the founders of Google the day they came up with the idea when they had 10 employees, the vision they had for the company and what it is today is very different. And so you have to be willing to add and pivot and change the earlier you are in a business's growth cycle. So the idea is great, but the team is what it takes to take an idea, morph it, change it, bolt onto it, kill certain ideas, add new ideas, and ultimately have a successful business. But the team, is the one to be able to do that. So add some advisors that have the ability to add to your story and team to give confidence that the idea can morph into something. And every step you go, you have to make sure that you add team that is going to give investors the confidence that they've been there before, done it before, know how to get through the inevitable, and the inevitable is the uncertain.
Yeah, really good actually that you mentioned advisors, I think, because, it's often, I expect when you're probably at Series A or, those later rounds where you've established a business, you've got some revenues, you can probably afford some advisors who will help with a lot of this. But I guess at the very beginning, at the seed and the pre-seed stage, it's kind of just you and your co-founders, and you're trying to figure it out yourself. So having a good set of advisors on will not only optically look good for you, but will also, hopefully give you that guidance that you need in those situations. Thank you for that, Matt. That's great. So then I guess, the pitch deck is obviously quite important. That's the document that most people are able to send to other people before they can actually speak to them or even get a call. What's your sort of feedback on pitch decks?
Yeah, the most important thing is to consider people's time. And investors have to consider your time too. I mean, you know what? While we have a second, let me just make one point. What people don't realize is that when you get an investor, when you sign up to take someone's money, you're a partner for a long time. And as important as it is to raise money, it's more important to have the right partner's money. And so to the extent you can actually wait for the right partner, do it. Don't take anyone's money. But sometimes you have to have money. Just be careful. Be very careful and have the right partners because you want support along that way. You don't want someone making your life more difficult. But reframing the question, so we talked about the idea, we talk about the team, and now how to present that, with the deck, with some type of materials. I'm a firm believer that the first way you present these things is to be able to do it in a one-page format. I really am. There's a couple of reasons as to why. One, you want to make sure you come across to investors as if you're, cognizant of people's time, because you want people to have the ability to issue quick no's. Quick no's are one of the greatest things in business. They really are. And you have to be able to allow investors to give you quick no's. You don't want to go in thinking you have to sell everybody. It's okay for no's. It really is. And so in a one-page format, if you're able to summarize the business, you take care of the timing thing, you allow people to give you quick no's, you don't waste your own time or somebody else's, and you don't give away too much information because you don't want to. You really don't need to. You can do everything you want to do in one page with presenting any first call for an investor, especially in emerging industry where, again, if you look at Google's first one-pager in their very beginning of their business, they could put everything, I promise you, they could put everything on one page. Google could still put everything on one page if they had to. You can too. Put it on one page, summarize the opportunity. It doesn't even matter where you are, your first round, your second round, your third round, fourth round. Put it in one page and clearly lay out what the business is, what the financing opportunity is, what the value, the high level stuff. And from that, an investor can decide, do they want to take the time or take your time? Because even if you think, well, I've got all the time in the world and every investor I will take time to talk to because it's worth that. The reality is at some point you become more ineffective by doing it and having, no's and no's and no's and time. You'd rather focus your energy on the right investors too, or a more targeted approach. So at least start with investors that take a one-pager, say, I agree to this meeting based on the items described in this 4-corner document. And from that, your effectiveness and efficiency of those meetings should increase dramatically just by qualifying properly. Don't try to, trick an investor to getting on the phone or try to use sales tactics to get on the phone. Like, it's okay to hear no. It really is. Just don't get on the phone and waste people's time. So that's helpful. As an investor that has a lot of companies, if you're managing outside capital and you have regulators, you also have mandates and you sign up to have processes by which you function. And so we have, certain requirements from our tax, lawyer, auditors, bankers, accountants, lawyers, regulators to be fiduciaries for our investors. So many times people think they have a great business, and a lot of times they do, and they just want to immediately protect it and go into an NDA. Well, what's impossible is for an investor that invests in lots of companies and lots of similar companies to sign every NDA that comes through. We would never be able to do deals. We'd be not a fiduciary to our investors if we limit ourselves by signing NDAs with every company. I mean, many of our companies, are software companies. Some of them do data. I mean, they are very similar. And we have to, as an investor group, be trusted with sensitive information to benefit our companies and the industry and our investors at the same time. And so we can't sign NDAs. And many companies want to sign an NDA right away. We don't sign an NDA. And by the way, this is venture policy 101. You're not going to get real investor groups to just sign NDAs unless they have confidence in doing a deal. So present a one-pager that allows for that to take place. Don't ask for investors that are seasoned investors just to sign something to see all your information. Understand what information you can let them see that's not proprietary or that's not going to give away your secret sauce. You have to give them as much as you can on a one-pager without them having to sign anything to see it. And at the same time, allowing for a quick no, or I would like to take the next step. It's crazy to me how often that does not happen. And then, I think lastly, I'll point out that then respect the investor's process. Go into understanding who the investor is, give a very simple, clean one-page document that explains it. And if you understand who they are, you may position that one-pager to be a little differently for an earlier stage or later stage investor. And what I'm seeing right now a lot, and this is what really smart companies are doing at this time when it's a little bit harder to raise capital, I see companies reaching out to us and saying, look, we know you're a group that sees a lot of deals. You have a lot of companies in cannabis and hemp. You probably know better than we do in many cases, at macro level at least, how this round should be valued. Here's our data. We'd love for you to give us an idea as to how you would finance this round. We've had 2 rounds of outside financing. We've had 18 months of revenue. Here's our last round was at this value. Here's how much we raised. Here's our month over month growth. Here's our market share. We think we need to raise X. Here's what we think we need use of proceeds for. Here's how we think we'd like to structure this round. Maybe it's a convertible to an A round or B round. We think a 10, 15, 20% discount is probably good. We'd like to have it be preferred shares because we've only had common up till now. Happy to offer independent board seats. Happy to offer, quarterly forensic accounting, field examination. Happy to offer. So they kind of say, here's who we are. And here's some of the things we think. You tell us, would you be interested in investing in this company if you could play with all these variables? And that's amazing. We say, wow, that's kind of fun. Yeah. How about we go into this and say, if we were going to do this deal, we've seen a lot of deals like this mostly. Here's how we would structure this. And then they say, accepted. And then a deal gets done. It's actually been amazing. So if you think you have something good going, why don't you just go to an investor and say, hey, we have a really great thing going. We're not going to try to force something to fit for you, but we think we do fit. We know who you are. We have the idea fleshed out. We've taken our time to understand your mandates and your companies. We think we're in your wheelhouse. We think we have a really good team. Here's what we have put together. And we'd like you to figure out if this is a fit for you, how would you structure it? And so maybe think about doing that as an example. So a lot of ways to present this, Anuj, but ultimately condense it in the first go and try to make sure that it's worth everyone's time because quick no's are fine.
Yeah, that's great. And I really like that one. I think a couple of people have mentioned it, but not, in such an eloquent way. You want to whet the appetite, really, of the investor, to see if they want to know more. And then you can take a bit more time to explain yourself. I mean, someone sent me a 60-page deck the other day, and that's obviously quite heavy, and I haven't made it through. But yeah, that's quite good in terms of the presentation of the information. I guess the other point is, it takes some balls to show that level of humility, I think, And when I say that, it means like you're really confident in your business and you haven't quite figured out the exact way that you want to structure this investment. So why don't you show it to someone who knows? And, that's predicated on the fact that you're confident that you've got a good, enticing opportunity for them. So conscious of time, I'm going to ask one more question before my trademark final question. You've outlined quite a few things in relation to the stuff we've done. Are there any other really glaring common mistakes that people make?
Yeah. Okay, so you haven't missed, well, we've mentioned it a little bit, but not specifically. And you can study Howard Marks and you can study all these great investors in the U.S. Bill Gross specifically, go look at Bill Gross's analogy on what makes an ultimately successful investment. Bill analyzed, every investment that he could get his hands on. Ultimately, what was the driving factor between a successful investment? Do you know what was number one over all studies? Guess. What were the top five? What were the top five most important qualities ultimately in a successful business?
A growing market, team, USP. Well, now you put me on the spot. No, go on. You finish it.
Those are some. Proper capitalization, IP, what type of intellectual property or copyrights, all those things. But you know what was number one? Timing.
Yes.
Timing is number one. If you had really great team, if you had really great idea, if you had really great capitalization, but you had the wrong timing, you could lose everything. So ultimately, if you had management, if you had a great team, you had a great idea, you had the right capital, you had IP, and all of that was really, really good. And let's just say you had the most poor timing, you would most likely not have a successful endeavor or less successful than it should have been. And so what you really have to constantly pay attention to, and timing is very hard to predict, obviously. One of the reasons why it's one of the most important factors of successful business, because it's one of the hardest to figure out. So you have to really pay attention and really be in tune with the world, with your business, with your market, and try to pace yourself to grow at the pace with which your business and your market naturally allows. You don't grow too fast, don't grow too slow. It's a constant balancing act along your entire journey. And if you time it perfectly, guess what? You could have okay management, good, not great, good team. You could have a good idea, not great. You could have good capital, not great. You could have good IP, not great. But if your timing was perfect, you probably have a very successful endeavor. So I'm telling you guys, timing is everything. If you think about the cannabis and hemp industry, how big is it? $16.5 billion in revenue last year. All this great growth in the headlines every day, all this amazing stuff going on. And you know what the reality is? If you look back 5 years from today, not one top 10 story, not one top 10 headline has been written yet. Not one.
Mm-hmm.
Not one.
Yeah.
That's a fact. So if you were in a mad race to keep up with a competitor's valuation or to go to public or, metrics for your structure that are egregious, you could have missed the entire boat. You could lose everything, and all have been because of timing. You went too big, too quick, too fast, tried to be like everyone else, didn't have the right investors, didn't pay attention to timing, didn't grow at the proper pace. The best is yet to come. History has not been written. Pay attention to timing. Timing is very important. And those of you out there who have not had the big exit or think that you're behind, nobody has won anything today. Nobody. And so timing is very, very important. That's the last thing I'll bring up. You brought up, three of the top 5 points in a successful investment opportunity, but timing is one that many people don't think about, and you really do have to pay attention to it all throughout all of the other factors in your journey.
Yeah, I'm really glad you brought it up. It's something that's dawned on me, certainly over the last 6 months, that we haven't really begun yet. Certainly in Europe, we really haven't. And so I'm glad that you've kind of reiterated that. Cool. Well, just, before we finish, my trademark final question is, what did your parents say when you told them you were moving into the cannabis industry?
Well, they are extremely supportive. So in my case, I could pretty much do anything and be okay. I know that that's probably an interesting question for a lot of people. Being born in Texas, Southern conservative, Christian, Republican state, typically that would characterize an individual that was about as opposed to cannabis as anybody. Not to mention the fact that, I grew up as an athlete, football, my family was full of professional athletes as well. And so, one would think probably not healthy. That's what they've been told. But fortunately, they have an open mind. And when you pay attention and you listen and you realize that there's amazing properties in these plants, all of them. And so they've been great and supportive. In fact, I would say at this point, I went back to Texas and did a speaking engagement there not too long ago. And I remember having some of my football coaches in the room and a strength and conditioning guy, the same guy that was testing me if I had use cannabis in my college career. If I failed, I get kicked off, in the collegiate team, or in the NFL case where I hung around briefly, same thing. You get caught, lots of trouble. Well, guess what? Today, literally today, is of this season, which may or may not happen, will be the first time they're not going to test for it. It's gone. It's gone. And so, not only when I was speaking to that audience, not only was this 15, 20 years from when I was being tested by these very smart figures that are amazing people, that are very smart and caring, not only was it this sort of humbling feeling to have them sort of recognize how times have changed, and then going back and you can see people noodling, maybe I thought about it wrong. Maybe I was wrong. Maybe I was told. And so I think we're at a point in time now where my parents, where your coaches, your people you've looked up to in your life are all starting to realize that they were wrong and that there is great benefit here. And so to be able to have your parents come around, to be able to have your athletic coaches come around, to see the sports that you played, their regulatory bodies coming around, it's all education.
Thank you, Matt. Yeah, look, we could have talked a lot more, actually, and I did have some more questions, but I really appreciate your time today, and I'd love to have you back on the show again further down the track, and maybe we can talk about some of the companies in your portfolio.
Wonderful. We'd love to do it, and thank you for having us.
Great. I'll provide links for everything in the show notes. So thank you. Cheers, Matt.
Cheers.